Hello, everyone, and thank you for attending today's webinar. Is shipping bottoming out or still descending? Let's not get too literal about the nautical part of that. Before we begin, a few procedural points. At the end of the session, we'll hold a Q&A as time allows. You can ask questions through the Q&A function on the right of your screen. Your question will only be visible to you and to the Flexport team. We will share a copy of the slide deck at the end of the presentation. And now, in our next slide, to make the lawyers happy, please do keep in mind that all information provided in this session is based on the situation at this current time and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. All right, what do we have for you today? We've got a great group of experts. I'm Phil Levy, I'm Chief Economist at Flexport, and joining me today, we have Sanne Manders, who is President of Ocean, Air, and Revenue Management here at Flexport and a veteran guest of the show. Sanne, welcome. And we are also delighted to welcome an expert newcomer, Jason Miller, Associate Professor and Interim Chair of Supply Chain Management at Michigan State University's Broad College of Business. Jason got his PhD from The Ohio State University. I say all this just to note how open-minded we are here on State of Trade, given that your host is a proud Michigan Wolverine. Jason, it is great to have you with us.
Thanks for having me, Phil.
All right. We got a lot to talk about today. It's, as probably anyone who's listening knows, it's been a wild few years in logistics. And we're going to briefly take stock of what's happened in our first section. And then what we're going to try to do is establish where we're going by taking deeper looks at the various modes by which one ships, at ocean, at air, at trucking and rail. And then we're going to try to put this all together and think a bit about what comes next. And time permitting, we're going to incorporate some of your questions. Before we do all of that, as is our wont, we are going to ask what your recent experience has been like. So we want to jump into our first poll question and get things rolling. So the question, over the last 6 months, has your experience of shipping goods been, here are your choices, better than even in 2019, better than 2021, but not yet back to before times? I haven't noticed any real change. Between prices and delays, some parts have improved, some haven't, or I don't ship, I just have a taste for fine webinars. So let's see, please join in. There are no right or wrong answers. I appreciate those of you who just have a taste for fine webinars. Let's see. So we are getting the leader, numbers coming in and evening out a little bit, but it's not really very much on the better even than 2019, and certainly you all have noticed changes. We've got in a plurality better than 2021, but not yet back to before time. But then a fairly strong showing for some things are better, some not so much. Okay, well, that's great. It's good that's actually going to match with some of the data that we'll show. But that's what we want to jump into is what has this whole experience like, and thank you for those of you who have voted. We really appreciate it. It's great to hear what you think. Let's move on and say, start with a couple of graphs. So as I said earlier, it's been a wild few years. For those of you who did business throughout, it probably goes without saying, but I wanted to give some broad context and some data to the discussion that follows. And I'm also hoping that some of these macro trends will ultimately give us insight into what comes next. And so I'm going to hold on to this microphone a moment more and give my two favorite graphs for how do we characterize this experience. And hopefully knowing where we've been tells us a bit about where we're going. So the first one looks at the US consumer, at US personal consumption expenditures. This is real personal consumption expenditures, which means we've adjusted for inflation. So that's not really explaining any of these moves. And what you see are three lines representing sort of the three major divisions of personal consumption. Services, here I've scaled these so that everything is relative to where it was on the eve of the pandemic in February 2020. In reality, services is the biggest of these, accounting for about 2/3 of consumption. Then we've got non-durables, the blue line there, the sort of royal blue line, and that's about 2/3 of the rest. These are goods that are supposed to last less than 3 years. And then we've got durable goods, which is the green line, which these are supposed to last more than 3 years. All right, what do we take from this? the nice thing about the way people behaved is we kind of have a reference point. If you look at what services did, services acted about the way you would have thought in a recession, that you get a drop off. Now, it was a sharper, quicker drop off than we usually see in recessions. And then you get a gradual recovery. And so, sometime in, say, early 2022, we kind of recovered where we were, crossed that 100 line, and then have gradually worked up from there with our steadily growing consumption. It's the good stuff that really drove what was going on in the logistics sector. And it was a surprise that you saw the initial drop-offs in durables and non-durables, but then you've had this persistent growth and this very rapid growth, which has largely persisted. So when I say very rapid, and the reason I was using 2021 as a reference there, you see where the peaks were. So durable goods, by the time you got to spring of 2021, you were seeing real durable goods consumption somewhere about 35% above where it had been not that long before, just about a year before. That's an incredible increase that came on suddenly, also after a bit of a head fake where it looked like everything was going down and then it went up, which makes planning hard, as you all know. The non-durables would actually look very impressive if it weren't sitting next to the durables, where we're up about 12% over that short time period. And what's happened since is we didn't keep up that really rapid ascent. We kind of leveled off and pulled back, but note, we didn't pull back to 100, for example. And in fact, there might have been a thought with durables that you were going to pull back below 100 because you had already ordered all these long-lasting things and moved your purchases up. Didn't happen. So we're still seeing, and in the end, you have our forecast. We just came out with our Flexport consumption forecast yesterday, which you can find on flexport.com/research. We see this continuing, and what you've seen is we're still somewhere 25 to 30% above where we were before. So strong consumption, especially of durables. Non-durables, they've held fairly steady, roughly 10% above where they were before. But to the extent that everyone was planning for continued growth, the growth rate has definitely slowed. So a higher level, lower growth rate. All right, let's go to the next slide. And this is the other one that I'm going to emphasize, which is, to me, there's a whole bunch of measures you can use to say, and I'm going to invite my expert panel here to talk about what they like. But this was constructed with the whole purpose of how tough is the supply chain situation during this. And you could measure this based on price, but there's a whole bunch of different prices, whether you do contract or spot and which lanes and so forth. So what we did here was we just tracked how long is it taking to move containers from their original cargo ready date to their destination port pickup. And we have tracked and reported this weekly. And what do we see here? We saw that you can measure this nicely in days. Two different trade lanes that we're talking about here, both coming from Asia. The Trans-Pacific eastbound, the black one, is going to the US. The blue one is going to Europe, so the Far East westbound. What you saw was that in both cases, a worldwide phenomenon, it just got harder to move freight. It took longer. Whether it was congestion, whether it was just simply lack of capacity and the time it took to get onto a ship. And this is an ocean version of this. We'll be talking about other modes soon. But you saw that things got dramatically worse. And you'll also see that the peak there in terms of difficulty was not that spring 21 consumption boom. It was significantly later. It was closer to spring 22 that this got really bad. And then you've seen that since then, those times have improved markedly, that that things have gotten significantly better, but, and actually this fits nicely with what turned out to be almost a majority poll response, not quite back to where we were in terms of timing. So this is why, just to set the stage, when we talk about, are we bottoming out, this, if you take this one as a measure of how intense have things been, how tricky have things been, you did see a dramatic improvement, which also then meant more slack in the logistics system. So from the from the perspective of those providing logistics services, you went from seeing really intense demand to significantly less. Sanne, I'm going to invite you to jump in here because you've been in logistics for quite a while now. It's an industry that's sort of known for having some ups and downs. How did this one compare to what you've seen? You've been at Flexport since our inception.
Yeah, and it's funny to look at this graph because you would expect that the cargo ready date to destination port departure is roughly similar to pre-pandemic at this moment in time. But there are a couple of things that are actually playing into this. First of all, there's slow steaming. If you compare the speed of vessels pre-pandemic versus today, pre-pandemic they were sailing on the Trans-Pacific around 17.5 knots. That's now 15.5 knots. So you're looking at a 10% there. That's not fully explaining the gap, but it's definitely explaining the gap halfway. And there are a couple of other things playing into this as well. At this moment in time, the number of blanks or the number of sailings that's being canceled is pretty high, right? It's 25-ish%, which means that cargo sometimes has to wait for a week to catch the next sailing. Even though there is enough space, there is still cargo rolls on certain port pairs, simply because in 1 week it might be that 3 alliances all cancel their sailing, right, independently of each other, and as a result, there's no alternatives there. So yes, I'm not surprised that it's higher than April 2019. What is interesting is that it's still, roughly 10 days higher, which is 10, 15 days higher, which is a lot.
Looking back,
as well on this one.
Looking back over this whole period, how does it compare to other shocks you saw? I mean, and do you now think that this was a sort of one-off, or is this the kind of turbulence that one ought to expect working in this industry?
Well, I do think that this shock that we've seen here was kind of like a one-off, right? It is a perfect storm. That said, will we see other shocks? For sure, right? At some point in time, somebody will be parking a ship in the Suez Canal in the wrong way. There might be an ILWU, hiccup, as we've seen in Canada, right? Little shocks will always happen. There might be a carrier going bankrupt, as we've seen in 2015 with Hanjin. There's always things that happen. But the one that we've seen over the past couple of years, I would say, I don't expect to happen again.
Yeah, they've really got to make those no parking signs in the Suez Canal a little clearer and easier to read than they are. Jason, let me call you in on this one and ask you. I won't sort of force you to work with this indicator, but when you look at sort of the system more broadly, at logistics and supply chain, do you have we'll talk to a bunch of specific metrics. Is there a broad metric, or do you just really have to dive into the details?
So it's interesting looking at this. I was pulling up in the background on my end that the Census Bureau each quarter has a stratified random sample survey of about 7,500 plants as part of the quarterly survey of plant capacity utilization. It is a mandatory survey. If you get it, you must legally fill it out because the Department of Defense. One of the questions they ask with that is, to what extent is your capacity utilization being affected by transportation and logistics constraints? Which sounds very similar to this. If you look before COVID, the peak of that series was just 3.2% of plants, and that was in the second quarter of 2018 in the midst of a fairly strong manufacturing boom. Today, we're at 5.6%, so still substantially above the pre-COVID high. But that series, interestingly enough, peaked in the first quarter of 2022 at 14.7%. And so when you think about that, it's basically saying, look, we've seen substantial improvement, again, 50 to 60% improvement from the peak, which looks very similar to what you just showed. But it also aligns very, very, very well with roughly 75% of our poll respondents that are saying, hey, we're better off than 2021, but it's not the before times, or between prices and delays, some parts have improved and some haven't. So to me, if I'd be looking at one sort of, broader omnibus metric, that one seems to be, tracking shockingly well with what y'all have, but also with what the polls say.
Okay, so we do see it isn't a crazy thing to take this as a system-wide. We give another data piece here, but it isn't to have a system-wide thing of it was really intense. It's eased off, maybe not all the way back, and we're going to be talking about sort of what comes next. Before we do, we're going to talk about inventories a bit, because really this is the sort of connecting tissue between where are consumers, where is demand, and how much is getting pulled through the logistics system. Before I invite Jason to talk about all this, I want to see what the experience has been of our audience. We've asked this one before, but we're going to ask it again because things change, as we've just been showing. So let me ask you all to weigh in and say, what are your current inventory levels? And this one we make simple and not very flowery. So the choices are, I have way too much, I have too much, I have what I need, I have too little, I have way too little. All right. Let me see here. And what do we have? All right, it's swinging around a little bit, but at the moment in the lead, we have I have too much on the inventory. But I have what I need is sort of there, and the way too much is down. We're going to give this a minute more because I want to sort of see what everybody says, and then we're going to show you for comparison what people said in some previous webinars. Different samples, we get that, but still, a rough test. So here we are, and actually now we have I have what I need in the lead. So we've got about, let's see, 44% who have either too much or way too much, and about 45% saying you have what you need, and then 11% with too little or way too little. And if those don't add up, it's because I'm doing this in real time and they're shifting around. But thank you for everybody who voted. Let's go on to the next slide where we can see how that compares. These were what we got in March, March and May of this year, where I think doing it off the top of my head, actually the
results are very similar to May.
Similar to May, not that far off. Better than March, but similar to May. Actually, yeah, look, you have what I need is 47 versus 48. That would be within the margin of error. So, Jason, I'm going to turn this over to you because you pay a lot of attention to inventories. First, does this surprise you, and how should we be thinking about inventories right now?
No, this doesn't surprise me at all. It actually aligns with what we were talking about right before the call, where I made the statement that it was going to be probably on the too much to have what I need side. So really right now what it looks like, if we move to the next slide, it really depends on what sector you're in. And so I basically, done a little play of the good, the bad, and the ugly with this. And so on the good side, what we're looking at is some key importing sectors where we've seen substantial improvement over the last year in seasonally adjusted inventories relative to sales. This is data from the Census Bureau's monthly retail trade program and monthly wholesale trade program. So on the left, we have general merchandise retailing. So that's your Walmarts, Targets, Costco's, and all your department stores, et cetera. You can see this story. We go into the pandemic, consumers get stimulus money, can't spend it on services, and so inventories to sales plummet. Demand is really, really, really strong and then inventories to sales stay really low and much below the pre-COVID level until the back half of 2021. And then we start to see inventories to sales start to increase dramatically, and then they sort of peak in the second quarter. Guess what? That's also the time period where we've got essentially record imports coming into the United States. And then we have seen some improvement. The ratio for May came in at 1.41, which kind of takes us back to 2018 levels. So we're looking a little bit better on that front. And probably the worst of the excess inventories have passed. The second sector where we've seen a lot of improvement recently is furniture wholesaling. And one of the things I focus on a lot is the wholesale trade sector. And the reason is with how Census Bureau categorizes a lot of businesses, a lot more activity is in wholesaling than we tend to think about it. I mean, wholesale trade is much larger than retail trade, as an example. And so furniture wholesalers are a key importing sector. And you can see the same story. Incredibly strong demand on the other side of the pandemic, inventories to sales plunge, and then we see this really sharp rise in the back half of 21 into 22. A lot of that is just over ordering. We see this peak in the second quarter of 2022. We start to see orders get curtailed. We have seen a little bit of an improvement in demand recently, and we've fallen back to 2019 levels. So this is looking good. So that's sort of the good piece. But if we look at the next slide then for the, maybe we're starting to get better, but we're still a little troubling. We're still above 2019. Building material retailers, your Home Depots and your Lowe's on the left. We did see a good reading for May coming in at 1.91, but that's a little bit higher than where we were even in 2019 when housing activity cooled in the first half of the year when the Fed raised interest rates. Boy, history repeats itself. And it's a huge difference from where we were in the early third quarter of 2020, as well as that first quarter of 2021 when, again, consumers ran out to stores with their stimulus money. We, again, overordered and housing cooled. Professional and commercial equipment and supplies wholesalers, that is companies that are bringing in computers to be sold, so your Dells, your HPs of the world and whatnot. Again, similar story. We've seen a buildup well in excess of where we were before COVID in 2022. We seem to have flattened out, maybe slight signs of improvement, but again, a little bit excess inventory lying around. And then sort of the piece where we're still seeing a lot of problems on the next slide is going to be in wholesalers of household appliances, electrical and electronics goods. The ratio was, 1.1 before tariffs, 1.2 during the tariff period because we had so much inventory brought in the back half of 2018. Things plunged down, but we're now at about 1.4. That's even worse than during the COVID pandemic month of April. So there's still a lot of excess inventories that need whittled away. And then the single worst sector is apparel wholesalers. So this is your Nikes, your Adidases, your Under Armours. Those companies actually qualify as wholesalers. Pre-COVID inventory sales like 2.25. We're hovering around 3.25 right now. We're like 40% worse. And so there's still a very, large excess of apparel and clothing that we need to whittle down. And so that's certainly going to be a drag on import volumes as we move through this year, given a lot of those products are going to be coming into the U.S. by container. So you really have to drill down into where you're at, but it doesn't surprise me looking at the numbers right now that if we were to create sort of a weighted index, we would be leaning right now on we still have a little too much inventory.
Jason, can I ask you a question?
Yeah, go for it. Sanne, you go first.
If you're looking at inventories, small versus large companies, is there any data set there that's because what I see within our customer portfolio is that smaller companies, simply because they're more cash constrained, have been more prudent in their orders and started earlier to slow down their orders and as a result might start reordering again. But that's anecdotal evidence of the customers that I talk to. I also just see a lot of difference between one and the other customer, right? Just how bullish they were on the near future. But do you have any data that's where you look at like company size in terms of or hypothesis and inventories?
So none of the Census Bureau data breaks things out by that, and obviously everything's going to be weighted to give the larger firms much more influence on this. On the only way you could start breaking out size, you'd have to look at publicly traded firms, but then again, publicly traded firms are very non-representative. They're much larger than average. We'll have Nike coming out with a Q2 earnings because they're on that kind of an off schedule where it's compared to the other retailers, which are offset by a month. So we'll be getting their data pretty soon for the second quarter, and I'm anticipating we're still going to see a lot of inventory relative to sales and a much longer days to turn than where we were looking at even before COVID, and certainly in 2021.
Yeah, no, and what you're saying here is that large companies weigh heavy into this index, and with our anecdotal evidence that smaller companies might have actually sold through more of their inventory, there is some pattern there, I think.
So I wanted to ask a couple questions on this, if I can. This is fascinating stuff. Jason, when you think about this, do you have a sense, and Sanne, you can weigh in on this too. If you look at the sort of before stuff, pre-COVID, you can see there were essentially norms. Post-COVID, you've seen things swinging around. Do we think that the norms, to the extent we settle there, or the targets for these companies are the same as they were pre-COVID? Do we just have to get back there? Or is there a new approach? There was some talk, certainly, as people looked at supply chains and they looked at the COVID experience and said, this just-in-time stuff has some downsides. Maybe we should be thinking just in case.
I tend to think there's,
and then Sanne?
Yeah, I think there's going to be a big gravity to get back towards where we were before COVID. I mean, certainly, that the apparel sector, it's over inventoried. There's just no doubt of it right now. Maybe some of the pieces we see a little higher safety inventories. I mean, I've been arguing for years that how we calculate safety inventories for things that we import is, an ERP system does a horrible job at doing it. So we probably do need to look at that a little bit. But when I start seeing inventories to sales that are 25% above where they were in 2019, I can't help but think there's going to be a desire to get that adjusted back. General merchandise, I think, is a good example that we haven't come back to 2019 levels, but we have come back to 2017 levels. We're seeing that as well in furniture wholesaling. And so the fact I'm seeing certain sectors that we know over-ordered starting to swing back towards where they were before COVID makes me think there is going to be a gravity to get back to the pre-COVID metric.
I fully agree with Jason. The CFO is in control again, right? Before it was the salespeople that said, I got to sell. Now it's the CFO again. And, working capital will be managed. And as a result, inventories need to be right-sized. Also, reliability on supply chains is improving, and as a result, you can go much more to just in time again. So I'm fully with this. It should be right sizing. There's always the question whether an e-commerce economy needs more inventory than a brick and mortar economy because you have a lot of distribution points and forward stock. I have not found the evidence of that yet, but I'm overall macro, I'm with Jason. It should come down to the levels around the levels that we've seen before, and I think furniture is a great example there. It's also a thin margin industry with a lot of working capital, so they probably have squeezed the lemon the first. Where apparel might have a little bit higher margins and can wait a little longer.
Okay, I'm going to control myself because this is cool, interesting stuff, but we got modes to talk about. Because, of course, the reason why we're discussing inventory, first we talked about sort of where consumer demand is, then inventories, and the idea is to the extent that we've had the kind of the bad and the ugly that Jason was showing, this has reduced the demand for logistics services, which has made for difficult times in various sectors, certainly not difficult in the same crazed sense of trying to push things through, but in the sense of falling prices, difficulties. Sanne, maybe you can talk us through we already talked about the OTI a little bit, but broadly, what's been going on in the ocean sector? What are the driving forces?
Yeah, and let's use the couple of slides that we have for this. I think this is the key slide of what I'm going to talk about. The demand is actually pretty reasonable, right? Phil has talked about it. The consumer is still healthy. Yes, we do have a little bit more of inventory, but it's not that demand has fallen off the cliff, right? Demand is pretty much back to what we, to 2019 in terms of, let's say, container space. But what you do see is that there's much more capacity, right? So here, when you're looking at the lines, the blue line indicates the demand for space, where the gray line is the total capacity that is available. Well, carriers do a lot to control that capacity, and that's what you see in the green line. So this is slow steaming, this is like blank sailings, this is even whole services being canceled. So you actually see that there is a lot being done to right size the capacity, the supply side to the demand side, but there's still a gap there. So that means there's too much capacity available for the demand that we have right now. And as a result, you see the price levels as we see them right now, right? The price levels are basically back to 2019. Although they're pretty volatile, and I'll talk about that in a second. I don't see this changing fundamentally in the next 6 months, and maybe even longer, simply because there's more capacity coming to the market, and we don't expect a very strong recovery of demand. So even with a small recovery, even with some kind of like a little peak season or a soft peak season in terms of demand, inventory replenishment, the capacity will outweigh the demand, and as a result, you will have, let's say, a low price environment in ocean freight.
Before you move on, the that new capacity that's coming on, do you have off the top of your head what the lag is? When was that ordered? Where if people are going to have, a new ship coming in the second half of 23, they placed that order when?
Yeah, 2 years ago, right? So it's and this is what you typically see in these cyclical industries, right? 2 years ago, everyone was making money like like the best day of their lives. So that's the moment that everyone started thinking about ordering new ships. Well, they're all coming to the market right now. Right, so we expect in the next half year the capacity to expand by 5.6%. Yes, there will be some scrappage from older vessels, but the overall capacity will be expanding. And 5% is 1.5 million TEUs, so it's actually quite a bit of capacity. Let's go to the next slide.
One more before that's fine. I was going to also slip in one audience question because it actually pertains right at this point, which is, Sanne, you made mention of blank sailings as one of the tools that people are using to do capacity. To what extent is that done sort of uniformly, or are we seeing a lot of variation along specific trade lanes?
So the blank sailings are typically done by the alliances, but not all alliances are organized in the same way, right? So you have the 2M, right? And 2M is doing vessel sharing, but they also, Maersk and MSC, have independent services where they have full control that are outside the 2M. And then for the ocean and the alliance, they work also in a different way, where one of them is actually using like shared vessel strings, so they pool the vessels, and the other ones have dedicated vessel strings. So the decisions are made a little bit in a different way, but essentially blanking decisions are made on an alliance level.
Okay, cool, thank you.
But keep in mind, it can lead to certain port pairs that all alliances have decided for themselves. All alliances and independent services have decided for themselves that in a specific week they're going to blank, right? So you see combinations, port pair combinations, where all of a sudden there's only one option that week, or there might actually be no option. You even see situations where 3 out of the 4 sailings in a month have been canceled. And as a result, an alliance might only serve it once a month, right? So that happens on certain port pairs, but that's also what you sometimes see is that even in this environment, cargo roles do exist, but they're hyper local, right? So here is what I just talked about. You see a little bit what the on order percentage is, and you see just all carriers have actually ordered quite a bit. And that's all coming to market this year and next year. Let's go to the next slide. I think, what is our peak season? Peak season in ocean, it should start today, right? Mid July, back to school, right? That's where we should see right now. What we see is a little bit of a sawtooth type of pattern. Is that at the 1st and the 15th of the month, general rate increases are announced, but they're mitigating during the month, right? July 15th had a pretty strong rate increase. So far, it's been sticking, but that's because the carriers have been managing a lot of capacity. But it's this kind of like tension between capacity management and at the same time utilization, right? And these carriers all have to make these decisions for their P&Ls. And as a result, you see this kind of like sawtooth type of pattern, where a general rate increase is announced, but then we're hungry again for volume, and then those rate increases are mitigated, typically partially, but sometimes fully. We expect a similar pattern to last for the remainder of the year, right? This should be peak season. It should start now. It should be till the end of September. There's not that much of a peak season that we're actually observing right now, and definitely not in terms of rates.
Jason, do you have any thoughts on ocean before we move on to air?
No, I mean, the only thing I'd say is if it'd be possible to hop to slide 11 real quick, is just to support what Sanne was saying, is if you take a look at where we're at in terms of U.S. imports, we're up in May about 4.5% from where we were in 2019. Now, this is using Census Bureau data for the metric tonnage of containerized imports. And so, it's not a collapse like 2009 during the global financial crisis. But what it is it's a regression to the long-term mean. And what I've done is on the chart on the right, basically shown for the first several months of the year, what do we typically see for imports? Just putting a trend line through that. And basically what's happened is we've come back to the long-term trend line, but what just has to be emphasized was 2021 and especially 2022. We're just complete and total outliers in terms of containerized importing activity. 2022 was essentially where we would have expected to have been in 2032. And so this was just something that was not sustainable. And so I think that's very important to consider as we're looking at the back half of this year. I've seen dire predictions saying containerized imports will be down 10 to 20% from 2019. And I don't see that scenario happening because that only ever happened one time, and that was in the midst of the global financial crisis in 2009 from 2008. So I don't see a scenario where that happens. We're probably going to be a little bit above 2019, maybe a little bit lower than 2018 levels because we were trying to bring everything in before the tariffs. But we're not looking at a scenario where we're down 20% year over year. That just, or 20% from 2019. That doesn't seem realistic given essentially recorded importing history. So that's the only thing I'd add.
No, it's a good point. Go ahead, Sanne.
I love this slide when I saw it, Jason, because this is exactly what's happening, right? We will probably rebound a little bit from the 2023, simply because we have this inventory overhang, and at some point we will start replenishing, so we'll rebound a little bit. But this is it's all about regression to the mean, and what we see here is not a demand problem, right, in terms of the supply-demand balance, but there's just too much supply. And what you're saying is 2032, we expected that. It's interesting whether the capacity on the water has been sized for 2032, because if that's the case, then we're looking at this scenario for a long period of time. So that would be a nice analysis to actually follow up with and see, if we're looking at the capacity on the water, is that sized on the 2022 volume? Because if that's what we're expecting from 2032, we're going to have a couple of rough years for the ocean liners, unless the capacity management is working well.
Good points. All right, we've got other modes to tend to. So let's jump back, and Jason, maybe you can lead us, or at least start us off, on what we should be looking at in the air market and what we've seen.
Yeah, of course. And again, it's going to be kind of a similar story as if we focus on air freight. And as I usually look, I look Asia to the U.S. and then Europe to the U.S. as kind of the key head haul markets. Air freight imports from Asia to the U.S. has been rough, down 20.4% year over year as of May. This is actually, as you can see on this chart, the weakest May going back to 2017. Down 12% from where we were in 2018. Big drivers of this are, one, less congestion at the U.S. ports, meaning we no longer are having this shift over of some cargo. Do we go by ocean? Do we go by air? We were seeing some diversion in 21 and 22 to move it by air to make sure that it could get here in a reasonable time and avoid the uncertainty about delays, as you all were talking about, when it's 110 days to get something from Asia to the U.S. And so we've had this effect. It doesn't seem that this is going to be, changing anytime soon. In terms of pricing, the BLS's import price index for inbound air freight, yes, that is actually an index, and the Fred call code is in the chart. That right now, we're actually 4% below February 2022. So air freight prices on aggregate have completely reverted to pre-COVID levels after having been double where they were about 18 months ago from today. So being double pre-COVID levels. And so we've seen this just, sharp, not only fall back, but really regression almost below the mean on the freight side from Asia to the U.S. And also when you look at what moves by air, high value apparel products, we just talked about record inventories to sales for that sector, and a lot of high tech products and computers, professional equipment, wholesaling, very elevated inventories to sales, and electronics wholesaling, elevated inventories to sales. So it makes sense that we've seen this. And then if we take a look in the next slide with Europe, we have, again, had a sharp fall from where we were last year at this time. Air freight last year in May was about 15% higher, because if you recall, the East Coast ports were log jammed up at that time. So again, you had this diversion of cargo to air freight. But we're essentially now back at where we were in 2021 and 2019, maybe a smidge above 2018 levels. And in terms of pricing, we're right now, the BLS is picking up about 22 to 25% above pre-COVID levels. So we still have seen elevated pricing. But again, if you compare that to the peak period of 2022 and the first quarter, and especially the first half of the year, we're down substantially from that point in time. So pricing-wise, we're looking better. We haven't seen the demand, fall nearly as much, though, in comparison as we have on the Asia to U.S. routes.
Yeah, if you're looking at the margins, though, for the air freight sector, the costs have also gone up significantly, right? It's not only fuel, but it's pilot cost. It's anything that inflation has had a real impact on the cost structure of the air carriers. So I actually do expect not all of this to be fully regressed to 2019 levels, because some of it is just additional cost. I agree with you on the Trans-Pacific. It's really the demand is there. It's really low, and what you start seeing there right now is some right sizing of capacity. You see some carriers, especially the integrators, have now parked quite a few planes, but there are also some of the independent freighter operators that are starting to run into financial troubles. Or are grounding planes to make sure that because it's just not economically viable to fly an old 747, especially when you're talking about the older ones that are more fuel consuming and are sometimes BCF, so the converts with lower payloads. You can't make them economical anymore at the current price levels. So, I think very much in line with what you were saying, the supply-demand balance is less favorable than in 2019 currently. That's because demand is really down. That's a little different story than in ocean, where demand is regression to the mean. Here it's actually below the mean, right? And Jason, you already mentioned to it. It's the high values, it's the apparel, but it's also just like, oh shit, I don't have inventory, right? That's a big part. That's a big chunk of air freight. And that, oh shit, I don't have inventory, we just confirmed with the poll, there was only a 2% that has way too little, right? That's just a small amount these days. Capacity is up. I think capacity is up for now in terms of, let's say, there's still a lot of freighters that have been taken out of the desert during the COVID days and back in the airs. So the older 747. Accenture, Seabury Accenture, they estimate there are 50 to 60 freighters that might go back to the desert when they have to get into their new into the heavy maintenance. So that will help there. But there's also just a lot of new 777s converge coming to the market. There's a lot of belly capacity coming to the market. I expect this market to look in terms of capacity, much more like a pre-COVID market, where freighters will reduce their share significantly and bellies will go up again. So that's what I'm expecting for the next 6 months. I don't think rates to fall off the cliff versus where we are right now. The rates will probably be a little supported because there will be new product introductions from the large consumer electronic companies that always give a little bit of a lift in the fall. There will be some replenishment. So I don't expect the rates to go back to the Q1 levels, where rates were dominated by debt freight, right? People with excess space, they just try to fill it up at marginal cost. That's not going to happen. That's not happening that much anymore, at least. But I'm also not expecting a big lift from here.
Sanne, maybe you could say a bit more about the dead freight then. We talked in ocean about how the ships had to be ordered well in advance. There was a change, wasn't there, in terms of how long the air freight contracts were as we went through the crunch of the pandemic?
Yeah, what you see during the, typically an air freight contract is a year or a quarter, right? But during the pandemic, a lot of freight forwarding companies had to lock in, but also direct customers had to lock into longer term contracts because otherwise you just didn't get access to space. So you see a lot of charter contracts with multiple year of duration that are still in the market. And specifically when demand is smaller than supply, the most expensive kilo is the kilo that you don't fill on a plane. So you rather have 5 cents a kilo than zero, right? So you see a little bit of that. Of course, that's not driving the market price, but those are price points that are sometimes available to a certain set of customers. When it's opportunistic for the person with the charter contract and the customer to make that match, right? As a result, you do see air freight prices that are well below full cost, right? In part of the market, I expect with capacity on the freighter side to leave the market because it's not economical to fly an older freighter right now on the Trans-Pacific, nor on the Far East westbound. You will start, as soon as your contract expires, you will start parking them. You saw this is exactly happening last week with Jet1X, one of these newer companies that entered the market with 4 747s a couple of years ago. They did really well, and now they're actually reducing their capacity to bring it in line with demand.
Cool. Our time is running short. Any last thoughts on air before we move on?
Let's move on.
All right, let's move on. Let's ground this thing. Let's talk about land, road and rail. Jason, maybe you can lead us off on.
Yeah, of course. So if we just take a look, I mean, it's next slide. We are in a freight recession in the trucking space. We've been in a freight recession since the third quarter of 2022. We seem to now be in a trough. We just got June industrial production data today showing a seasonally adjusted manufacturing dropped a little bit in June. It rose in May and April. It had fallen in March. So we just seem to be sort of at the bottom of a trough. Probably in terms of trucking ton miles down a little bit over, somewhere around 2% year over year. That may not seem like much, but again, it's a capacity story. We kept adding capacity all through 2022, and we started to see seasonally adjusted employment sort of level off in trucking, but we're not seeing large decreases yet. And until we start to see that, it's difficult to see an environment where rates are going to be, looking that good from a dry van carrier standpoint. We should be at getting very close to an inflection point where contract rates can't fall that much further given where spot rates are at. That's kind of shown on the chart on the right using DAT Freight and Analytics dry van truckload spot rates compared to the BLS producer price index for dry van over the road truckload operations. You can see they're connected. Spot rates go up rapidly. Contract rates get pulled up because that's mostly what BLS is capturing. Spot rates go down. Contract rates get pulled down. We had that incredible run up in the second half of 2020 through really about January of 2022. Then spot rates started to drop steeply. Contract rates started to drop. That initial drop was primarily because the contract rates had just caught spot rates, so carriers had an incentive to adhere to the contracts. But then we threw in this steep decline in activity in 2022 that's continued a little bit into 2023. So right now it feels that we're in a trough. For anybody on here wanting good news for a demand surge, I don't see a good case really even over the next 9 months to expect anything. And I'd say a best case scenario for a actual sustained increase of seasonally adjusted demand for trucking is going to be Q2 of 2024, and that's assuming the Fed is able to start lowering interest rates because they feel inflation is under control. But right now, until we start to see interest rates go down, it's difficult to see what's going to really spur single-family housing starts, what's really going to spur business investment, which is what we're going to need to see a substantial increase in trucking activity. So unfortunately, a little bit of a rough patch ahead for us.
Join the crowd watching the Fed.
Yep, that's right now the biggest thing. We haven't had interest rate dominated discussions like this really since I'd say the 1990s, because we had the global financial crisis hits in 2008, and that is what really drives the decrease in demand.
Yeah.
And if we think, since we're talking a lot of imports, intermodal comes up. If we shift to the next slide, intermodal rail is hurting right now. We're down 8% year over year from where we were in 2022. What's real, this is a combination of not only fewer imports, but also this secular shift away from the West Coast more towards the East and Gulfport coast. And so obviously West Coast is prime-time intermodal. You're looking at 2,000 plus mile moves to get to Chicago and then the East Coast. We're seeing fewer of those opportunities. You start coming in through, New York, New Jersey. A lot of that's just going to move by truck to the Lehigh Valley area in Harrisburg for ultimate distribution. So with that, we have seen intermodal prices come down a little bit. They are still elevated due to higher fuel. Intermodal savings is kind of sitting, around 30% cheaper than truck based on Journal of Commerce's data. But right now it's a tough time for the railroads. In terms of intermodal loading, it's a tough time for any of the intermodal marketing companies, just because there isn't really that demand there right now. And again, it'll always go back. The railroads missed the prime time, which was the second half of 2021. If the networks hadn't been snarled, you would see that yellow line would have been easily setting an all-time record in the second half of 2021. but instead we were at 2019 levels, which were quite soft. So again, not a really great case to be made that we're going to start seeing a substantial increase in intermodal movements, not with the sharp decline in dry van trucking prices, coupled with fewer West Coast imports and the secular shift to the East Coast.
All right, that's grim but enlightening. We're going to go to our last poll. We're going to give everybody their final say. First, the audience, and then Sanne and Jason. So, for the audience, or we want to know what you think. 6 months from now, do you expect we'll be looking back at a regular peak season and a return to normal? Prices and freight rates will be elevated from where they are now. Prices and freight rates will be depressed from where they are now. Logistics sector effects will be swamped by dropping interest rates and stronger economic growth. That's part of the Fed version that Jason was talking about. Or alternatively, logistics sector effects will be swamped by higher interest rates and a move toward recession. So let's see. It looks like, thank you for all of you who have voted, at least for the moment, people think we've bottomed out. That they think that as you go forward, prices and freight rates will be elevated from where they are now. And then we've got these aren't necessarily mutually exclusive questions, aware of that. Thank you all for humoring me. But we got a decent number who think we're going to be looking at a regular peak season and pretty much a return to normal. Still a decent chunk here where 20% thinking that we've got further to go down below this. Okay, so a bit of a spread. It is a hard question, but that's why we bring you such well-versed and thoughtful people to talk about it. So that's what we're going to wrap up on. Is I want to make sure that we answer the question that we set out. Is we've got shipping and logistics. Thinking you've discussed it in a fair bit of detail. I heard you both saying as we went through each mode that we probably have bottomed out. That you're not in the things have further down to go. Did I hear that correctly? Jason, why don't you go first?
Yeah, I don't think we have that much further to go, barring some type of shock that we're not seeing happening. It does seem like we're at the bottom. The bigger challenge is what is that surge of demand that gets us sort of out of this trough. And that's where I have a more difficult time seeing a rosy scenario.
Okay, so we're at a bottom, but it may be a long, flat bottom.
Yeah.
Okay. Yeah. Sanne?
I think it's a long, flat bottom. Bar any weird things in the world's history. I think the way out of the bottom is on the capacity side. It's parking more planes and scrapping more vessels. Simply because there is just too much capacity for the demand. On the air freight side, I do see some kind of like demand. There will be some replenishment cycle in next year. So I think that's artificial. That's now lower than normal, so that will probably recover to normal. But yeah, I think we're at the bottom, but we will stay at the bottom for a while.
Okay. And very quickly for each of you, give me a thing or so that you're watching to sort of figure out when there might be an upturn. Jason, you want to go first? Do you have a favorite indicator you want to point to?
So mine is more to see if there's going to be a real downturn to spending, and that is light truck sales and industrial production of motor vehicles. That is like the one shining spot right now of the U.S. economy. We had consumers buy more light trucks the second quarter of this year than the second quarter of 2019. Industrial production in that sector has been at record levels the last 3 months on a seasonally adjusted basis. If we start to see substantial declines in motor vehicle sales, that for me is going to be the red flag of, okay, the consumer is truly overextended. We now really are more likely to see a recession. So if there's one indicator I look at putting a lot of weight on, it's that right there is light truck sales in the United States.
All right, interesting one. Sanne, do you have something you like to watch?
It's so funny that you're saying this because I started my career in truck manufacturing, and I always say, just look at truck sales. It's the best indicator. And now I hear it from the professor. So I wasn't too far off in my early judgment in my career. So That's a great wrap up on this one.
All right, we close with consensus. Very nice. All right, well, thank you both very much. We are out of time, but very much appreciate you, Sanne and Jason, for lending us your expertise. We thank all of you for attending today's session. We will email out the slides and a link to the recording by tomorrow morning. There will also be a short feedback survey presented when you log off this call. Please take a moment to share your thoughts and feedback with the team so that we can continue to curate great content for you. With that, thank you again and have a great day.